QuickBooks Pro Desktop 2021. Adjusting entry, accounts payable, foreign currency. Let's get into it with Intuit's QuickBooks Pro Desktop 2021. Here we are in our problem 4 practice problem. We currently have the open windows open. You can open the open windows by going to the view dropdown, selecting the open windows list. In prior presentations, we made a purchase of equipment on account, which we're going to pay in foreign currency in the future, exposing us to some risk, and therefore we've tried to mitigate the risk by adding a forward contract. Let's take a look at that now. We're going to go to the reports dropdown. We're going to go on down to the company and financial, take a look at that balance sheet standard balance sheet. Let's go to the customize reports up top, changing the dates from 01/01/21 to 12/31/21. Then we'll say okay. So then we have down here, we had this purchase of the machinery and equipment, which we're going to be paying in foreign currency at the end of the process, that we put on the books with the current spot rate, which was 60,000, which represents the current spot rate that we're going to be paying, which will actually be 100,000 foreign currency units. We then tried to mitigate the risk of the payable related to that, which is down here, with a forward contract now. So now we have a receivable, which will also change with regards to the change in the foreign currency related to our currency. However, it will change in the opposite direction, which should mitigate some of the risk. Part of the problem, however, or part of the confusion can be that we put the machinery and equipment on the books using the spot rate at the point in time the purchase was made. We put the accounts receivable on the books and the forward contract on the books using the forward rate looking forward, the speculative market rate looking forward. So now what we need to do is imagine it's the end of the time period, adjusting entry as of 12/31, and we need to value then the accounts that are going to be generating or using or spending or receiving foreign currencies to the current rates so that our financials are correct as of this point in time. That means we're going to adjust the receivable here because this is going to be in foreign currency that we are receiving, and this payable down here. We're going to start with this payable, which is a result of us making the purchase of equipment. This one we're going to be using the spot rate to adjust it as opposed to the forward contract, which we will be using the forward rate. Let's first think about it in Excel. So we can see this in Excel. And what we have in Excel, same kind of scenario, but it'll be a little bit more transparent here. We're talking about the receivable. We're talking about the payable that we have here. And so let's make this one yellow right now so we can kind of put my eye there because we got a lot of similar numbers. And so we'll say that's the one that we're looking at this point. And we want to revalue that using the current spot rate. Now notice the difference here. We're going to revalue this item is not going to go to the depreciable asset. We're not going to revalue the property in this case, but rather record the gain or loss that is going to result down here on the income statement. So the property's on the books, and for purposes of this problem, they will remain on the books and we will not change it throughout the problem here. The adjustments for the currency valuation and changes will be on the income statement. All right, so what's going to be the change? Let's pull out the trusty calculator here. We're going to be paying 100,000 Australian units of dollars, Australian dollars. We're going to be valuing that with the current exchange rate as of 12/31. That's going to be the spot rate, not the forward rate. So we're going to be using the spot rate here. When we look at the forward contract, we'll be looking at the forward rate, the speculative rate. So this is going to be the 100,000 times the spot rate, which is 0.61. 0.61, that brings us to the 61,000. We currently put it on the books. We're looking at this payable on the books for the 60,000. So obviously that's a $1,000 increase on the payable. So the payable basically goes up 1,000. Now, is that good or bad? Well, the payable is going up, so that's going to be a bad thing because we're paying in payables. If you think about this in terms of the rates, we had it on before where we could say that $1 Australian would be purchasing 0.6 US dollars. Now $1 Australian purchases 0.61 US dollars, purchasing more US dollars per unit of Australian dollar. Therefore, the Australian dollar has gotten stronger, and we're going to be paying in Australian dollars. So if the Australian dollar gets stronger compared to our dollar, then that would be not good for us. So that's going to be a loss. It's going to result then in a loss. So if we think about the transaction, we're going to say that we're going to have a loss, which is going to go on top. That will be the debit for the foreign currency transaction loss. Now, this is where you might think that you would be debiting the depreciable asset, but no, we're not changing the depreciable asset. we're going to record it as a loss for the change in the currency here. And then the other side is going to be going to the accounts payable for the Australian dollars. I'm going to recalculate this again. This time I'm going to do it this way. Equals, putting brackets around. We're going to take the larger number of the spot rate minus the smaller number of the spot rate, close up the brackets, multiply it times the 100,000 Australian units, which will once again give us that $1,000. That's our change. Let's go ahead and record this out. If we record this out, we should get to that 61,000 that we calculated in the payable here, 61,000 on the payable. So we can go to the foreign currency transaction loss down here. Let's do that first. Loss is going to be equal to the 1,000 loss. That's going to be a debit, so that's going to be net income would then be going down. Then we have the payable, so the accounts payable is going to be here. Something's in it. It's going to double click on it, say plus, and then close that, and then I'm going to say plus, and then take that 1,000. That brings it up to the 61,000. So there we have it. So now let's see if we can record this in the QuickBooks system. To do that, we can utilize the spot rates in QuickBooks. So I'm going to go back to QuickBooks. We're going to go to the lists drop down. I'm going to go lists and take a look at my currency lists before we do the transaction. The Australian dollars, if it was today, if today was the day we're doing the transaction and I was at the current rates, I could go to the activities down below and download the latest rates here. But this is a practice problem, so we cannot do that. I'm going to double click on it and manually input the rate. Now this is the spot rate, not the forward rate. So this would be the rate that would be downloaded if we were to say we want to take it as of this time. This rate would not be downloaded because that's the forward rate, but this rate would, the one we need now, 0.61. So we're going to say, all right, that's the one. This is 0.61 as of the end of the year, 12/31/21. There we have it. Saving that, okay. Then what we want to do is ask QuickBooks to basically do this adjustment for us by going down to the activities rise up, and we want to say home currency adjustment. Give me the home currency adjustment, QuickBooks, as of the end of the year, 12/31/21. And then we want to use the Australian dollars, and there's the rate that it's going to be using now. So go ahead and calculate all the accounts that have that Australian dollar item with it. We're just looking at this one right now. We'll get back to the customer side in a future presentation. So we're looking at this one here, where we had the 100,000 Australian dollars previously on the books at the 60,000, now changed to 61,000, difference being that $1,000. This will then generate the adjusting entry, which should look like pretty much what we have in Excel. Let's save it, close it, see if that is indeed the case. Save it, close it, checking it out. We're going to close this up to check it out. Back to the balance sheet. And then within the balance sheet, if I go to the accounts payable, we're now at that 61,000, which is exactly where we should be at this point. So there's the journal entry that was created automatically by the QuickBooks system. Double clicking on it, there's the journal entry that was generated. The generated journal entry is right there. So then I'm going to close that back out. And the other side should be on the income statement, profit and loss, P&L. Reports drop down, company and financial. Let's take a look at the profit and loss so we can observe it there. 01/01/21, 12/31/21 being the range. There's that $1,000 loss on the income statement as well. So it's in there as an other expense. So it's there as a loss on the income statement. Let's just check it out on the trial balance, the trusty TB, because that's a good place to see everything put together. Balance sheet on top of the income statement. Reports drop down, accounting and taxes, trusty trial balance, good old TB, from 01/01/21 to 12/31/21. And then there we have it. I think TB stands for like a disease or something like that, but I always hear trial balance. So TB seems like a good thing to me. It's trial balance. That's trial balance. So there it is. We got the balance sheet on top of the income statement. There's our $1,000 gain or loss. And then there we have the 61,000 in the accounts payable. So next time we'll do a similar transaction for the forward contract, but we're going to have to use a different rate in order to do that. So that'll be a bit of a complication for that one, something we have to keep straight if we're using forward contracts as well. So spot rate versus forward rate. We'll continue with that next time.